Hey traders, Raghi here, and in tonight's free video I'm going to walk you through probably one of the most powerful tools I use, how I use it, and give you some scenarios for the upcoming economic releases where this kind of approach absolutely is the best way to capitalize on volatility without letting the wheels fall off the wagon. Now, while I'm going to use some Forex trading examples here, this could apply to any currency trade. I mean, whether you're executing this on the Forex side of things or on the Forex futures side of things or with a currency ETF, typically, regardless of how you're executing your currency trade, you're going to want to take a look at what's happening in the spot market, even if that's not necessarily where you're going to enter the trade or even how. Remember, you can currency trade through obviously the spot or the Forex, through futures, through currency ETFs, or options on futures or options on those currency ETFs. So I don't want you thinking it's Forex or nothing. But I'm going to use the price movement ranges and the calendar of typically kind of this Forex mindset because it still is the largest marketplace for currency. So kind of keep that in the back of your mind, regardless of how you're entering these trades, through which avenue, if you will. Okay, so first of all, head on over to the economic calendar. I believe Forex Factory has the best economic calendar, regardless of whether you're trading futures, equities, or currencies. This is, to me, one of the best because any equities trader now knows you can't ignore data that comes from abroad. We can't ignore the euro. We can't ignore the fact that we're going to have an ECB press conference and the minimum bid rate on Thursday. If you ignore these because they're outside the U.S. shores, outside the typical equities net that you would cast, you're going to get blindsided by volatility. Now let's talk about volatility. First of all, I know it's going to happen in terms of the scheduled economic events, right? There's really no way to know that Doha was going to disappoint, but we know Doha was coming this weekend, right? So there's an event, but we're not sure what's going to happen. And it's happening over the weekend, so it's going to impact Sunday to Monday. Then we have unforeseen economic events like the tragic earthquake that's happened in southern Japan, affecting Toyota, affecting possibly the rate hikes in Japan. But most economic releases are going to be pretty consistent, pretty stable, and very predictable in terms of their volatility. Let's get right to it. We have a monetary policy meeting minute for Australia, and then we have RBA Governor Stevens speaking tomorrow. So within about, 11 hours, we've got two major economic releases affecting the Aussie. We know that on each economic release, we're going to expect a burst of volatility. So let me just grab the Aussie US. We've been having some great trades in the Aussie US, just following the trend. One of the ways that we follow the trend effectively is we wait for corrections or swings. And the way that we would define how much the market could move are by these probabilities, the movement range by hour of day, and also the movement range by day of week. So I know this is going to account for about 2/3, or as you can see here, 68% probability. I know that at roughly 2/3 of the time, this is the way the Aussie is going to move from a low to high range. I know because of the economic event coming, and I can line it up with the time, I'm going to likely expect the upper end of price movement range, which means I'm going to be looking for the Aussie US to operate at a minimum of about 26 pips, upward of 32. Now, I'm going to really expect 32 or more because it's a monetary policy meeting minutes and because the head of the RBA is going to be speaking. This is what I call the 32% rare air. In other words, if we go above 32 pips or above about 30 pips, we're up in that 32% rare air. In other words, 68% of the time, we're going to be operating within this green, right? These green bars. But when we get above that, that's the rare air. When would rare air occur? When we have very high impact economic releases, like we're going to have, major central bank releases. So then I ask myself, how far am I from a level that I'm watching, whether it be a stop, whether it be a profit target, or specifically an entry. When I have an entry that might be within, say, 32 to, say, 42, maybe 50 pips, I know that I might get what I call a catch the wick opportunity, what I call a CTW. I know that I could be plus or minus, this 30, 32 pips, upwards of, who knows, it could be 50. But by the way, I don't know what the upper end is going to be. I don't need to know necessarily, because if I'm ready for about 32 pips and I get 50, am I panicking? No, if I wasn't even ready for 26 to 32, if I was expecting a typical, say, Asian session type quiet time looking at, say, 20 or 24 pips, and all of a sudden I get times two that means I wasn't looking at the calendar and I wasn't thinking about what happens if we enter that rare air. We're going to have a very similar event tomorrow with the euro, and I can do the same thing there. So scroll down to the euro here. And what I'm looking for again is, I know what time that German economic sentiment's coming out, but I know this is a major economic release for Germany, and I know it's going to affect the euro. So I'm going to be expecting 45 to 50 pips on the upper end. A minimum of 35, but really I should be thinking again, what happens if we put in some rare air? What happens if I'm in that 32% rare air? Where on the Euro US am I looking for follow through to profit targets? Where are my stop losses? Where are my entries? And the terminology I use is striking distance. What if you knew more often than not where the pair is capable of going right in front of an economic release, because you know the timing of the release and you know the possible, very likely price movement, or at least the minimum that you should expect because of the impact. That's what this data does, and I do this for every single pair. When you do this, you're able to capitalize on volatility because you have a pretty good idea of how far price could go. You're not getting steamrolled, and if anything, you're able to get opportunistic and very tactical with your entries. And that's the power in these kind of numbers.